Here's the thing. Most people think passive income means starting a business, buying rental property, or figuring out some complicated system they don't have time to understand. They're wrong. The most powerful passive income I've ever seen built came from 3 accounts that anyone can open this week. If I had to start completely from zero today, zero savings, zero investing experience, these are the exact 3 accounts I'd set up first, in this exact order. By the end of this video, you'll know which one to open today. Before we get into the accounts, let me address something. The reason most people never build passive income isn't laziness. It's not lack of information either. There's more free financial content online right now than at any point in history, and most people still haven't done anything with it. The real problem is that the concept feels impossible to start. You hear passive income, and your brain immediately goes to rental properties, drop shipping, some course about flipping products, starting a YouTube channel or a newsletter. And look, all of that is real passive income. People are genuinely building wealth that way. But it also requires time, capital, skills, and a stomach for failure that most of us are still working on. What I'm covering today is different. These are the foundational accounts, the ones that run in the background whether or not you're doing anything else. You don't need a business idea. You don't need a side hustle. You don't need to understand quarterly earnings reports or whatever the stock market did this morning. You set them up, you fund them on a schedule, and they grow. That's the whole thing. Now, I want to be straight with you. None of this will make you rich in 6 months. Anyone telling you otherwise is selling something. What these accounts do is build the kind of slow, unglamorous, compounding wealth that actually changes your financial situation 5 and 10 years from now. The people who are financially comfortable in their 40s and 50s aren't the ones who found the right crypto at the right time. They're mostly the ones who started boring accounts in their 20s and didn't touch them. 3 accounts. And if you start with $25 today, your future self will understand exactly why that mattered. Let's get into it. Account 1. High Yield Savings Account. Account 1 is the one most people have heard of and still haven't opened. The High Yield Savings Account. Here's what's probably happening with your money right now. If you're keeping it in a traditional bank account, one of the big national banks, the kind with branches everywhere, you're almost certainly earning next to nothing on it. Some of the biggest banks still pay as little as 0.01% on savings. The national average sits around 0.39%. On $1,000 at that rate, that's less than $4 a year. A high-yield savings account in an online bank pays around 4% annually right now. Some accounts pushing higher than that. On the same $1,000, that's $40 a year, just for having your money in a different place. Same FDIC protection, same access to your funds, just a lot more interest. I know what you're already thinking. $40 a year isn't going to change my life. You're right, that's not the point of this account. Here's the actual reason this is account number 1. There's a body of research, Mullainathan and Shafir did the most well-known work on this, showing that people who operate without a financial cushion make measurably worse decisions across almost every area of their lives. Not because they're less smart or less disciplined, because financial stress occupies mental bandwidth. Part of your brain is always running a background calculation about whether you're going to be okay, and that takes up space. When you have 3 to 6 months of expenses sitting somewhere earning real interest, that calculation quiets down. You make better decisions with your investments because you're not scared of losing money you can't afford to lose. You take better career risks because you're not one bad month away from a crisis. The fund isn't your wealth builder, it's what makes everything else possible. Think of it as the foundation. You build on top of it, not with it. One more thing on this. The psychological effect of having a cushion is not theoretical. People who've built one consistently describe the same thing, a kind of low-grade tension that disappears. You don't notice it was there until it's gone. That calm is worth something. It's hard to put a number on, but it affects every financial decision you make after that. So, what you're looking for here isn't a get-rich account. You're buying yourself the mental bandwidth to make good decisions with the other 2 accounts. Simple first step. Open a high-yield savings account today. Marcus by Goldman Sachs, Ally, and SoFi are well-known options in the U.S. Compare their current rates before picking one. Transfer whatever you can. If that's 1 month of expenses, great. If $50, also great. The account needs to exist before you can build it. Set a target, 3 to 6 months of essential expenses, not your full budget, just rent, food, utilities, the stuff you absolutely need. That number is probably smaller than you think. Once you know it, you have something to work toward.
Account 2. Brokerage account with dividend ETFs. Account 2 is where passive income starts to look like passive income. A taxable brokerage account, specifically one where you're holding dividend ETFs. I'm going to explain what that means in plain language because this is exactly where most beginner finance content either buries the lead or loses the plot. A dividend ETF is a fund that holds shares in dozens or hundreds of companies at once. Some of those companies, usually older, more established ones, pay dividends. That means they share a portion of their profits with shareholders on a schedule, usually quarterly, some monthly. So when you own shares of a dividend ETF, you get paid automatically, several times a year, just for holding it. You don't do anything. You don't log in. You don't make a decision. The companies keep operating. They generate profits, and a slice of those profits lands in your brokerage account on a schedule. That's the passive income. Now here's why an ETF specifically, rather than individual dividend stocks. If you buy shares of one company, say a big retailer or utility, you're betting everything on that one company staying healthy and keeping its dividend payments. Companies cut dividends. Companies go bankrupt. It happens more than you'd think. An ETF, like SCHD or VYM, holds 50 to 100 companies at once. If one of them cuts its dividend or has a bad year, you feel almost none of it. The rest of the fund absorbs it. You're diversified without having to think about it. Let's talk actual numbers. SCHD has historically yielded around 3 to 4% annually. If you invest $1,000, that's $30 to $40 in dividends per year deposited directly into your account. Invest $10,000, and you're getting $300 to $400. That's money hitting your account while you're at work, asleep, on vacation, not paying any attention to the market at all. But here's the part that actually matters for long-term wealth building. Most brokerage accounts let you turn on automatic dividend reinvestment, DRIP it's called, which means every time you receive a dividend payment, it buys more shares instead of sitting as cash. More shares means more dividends next quarter. More dividends means more shares. It's a loop, and it compounds over time in a way that looks slow for the first few years and then becomes genuinely hard to look at without rethinking every financial choice you've made. Year 1, you've got $1,000 invested, earning maybe $35 in dividends, which buys a little more than half a share. Year 5, your original investment has grown. Every dividend has bought more shares, and those new shares are generating dividends too. The number starts looking different. Year 15, the compounding has had time to actually do something. A lot of people who understand this viscerally are the ones who opened their brokerage accounts at 25 and checked them again at 40 and needed a moment to sit down. The earlier you start, the less the monthly contribution amount matters. Time does more of the work than the dollar amount, especially in the early years. Something worth understanding about individual stock picking, since people always ask. I'm not recommending you try to win winners, not because it's impossible, but because the research on it is pretty discouraging. The vast majority of actively managed funds, run by professional analysts with full-time research teams, underperform simple index and dividend ETFs over 10-year periods. If the professionals with Bloomberg terminals and teams of analysts can't reliably beat a dividend ETF, you probably shouldn't count on doing it on weekends. An ETF keeps you from needing to do that. Simple first step. Open a brokerage account. Fidelity, Charles Schwab, and Robinhood all have no minimum to open. Buy one share of a dividend ETF. One share of SCHD is currently trading around $30 to $32, though always check the price before you buy. That's your starting point. One share. Then find the dividend reinvestment setting and turn it on. Add to the account whenever you can. $25, $50, whatever your situation allows. The habit matters more than the amount, especially early. One thing worth flagging, this is a taxable brokerage account, which means the dividends you receive are taxable income in the year you receive them.
That's different from account 3, which we're about to cover. The taxable account still makes sense to have. No contribution limits, no restrictions on when you can access the money, but it's worth knowing the difference going in. Quick check-in. If you're sitting here thinking, okay, this makes sense, but I genuinely don't have much to put in right now, that's fine, honestly. Starting with $25 or $50 a month is no joke. It's actually how most people who end up with real wealth got there. Stick around for account 3 because that one has a feature that changes the math significantly. If this is clicking for you, hit the like button. It helps reach people who could use this. And subscribe if you want more content like this. New video every week. Account 3. Roth IRA, or your country's tax-free equivalent. Account 3 is the one I wish someone had walked me through earlier. The Roth IRA. Here's what makes it different from everything else we've talked about. The money you put into a Roth IRA has already been taxed. It comes out of your regular paycheck after the government has taken its cut. But when you take that money out in retirement, it comes out completely tax-free. Every dollar of growth, every dividend, every capital gain, all of it untaxed. That's not a small thing. Let me show you what that actually means in numbers. Say you put $200 a month starting at $25 into a regular taxable brokerage account. At a 7% average annual return, roughly the historical average for a diversified stock portfolio, by age 65, you'd have around $524,000. That's real money. But when you start withdrawing, you owe taxes on the gains. Depending on your tax situation, you might be giving back $80,000 to $120,000 of that. Same $200 starting at $25 inside a Roth IRA, same 7% return, same $524,000 at 65. But it's all yours. No taxes owed. The government doesn't get a share of what your money did while it was growing for 40 years. Over long time frames, that difference is substantial, often $80,000 to $150,000 or more depending on your tax bracket when you retire. That's not a rounding error. The Roth IRA has a contribution limit, $7,500 per year for most people under 50 in 2026. That works out to about $625 a month maximum. You can't put more than that in. But you don't have to put that much in. You can open a Roth IRA and contribute $25 a month. The account just needs to exist and be funded, and the tax-free compounding starts immediately. There's also a flexibility feature that doesn't get talked about enough. You can withdraw your contributions, not the earnings, but the money you actually put in, at any time without penalty or taxes. So if you put in $5,000 over the years and hit a real emergency, you can take that $5,000 back out. You lose the compounding on it, which is painful, but you're not locked in the way some people assume. It's not as rigid as a 401k. Inside your Roth IRA, you can invest in the exact same dividend ETFs we just talked about. SCHD, VYM, whatever you choose. So now you have dividend income compounding completely tax-free. That's the combination that does the real long-term work. A fund that pays you dividends, automatically reinvesting in an account where none of those gains ever get taxed. There's one more angle on the Roth IRA worth mentioning. A traditional 401k or IRA gives you a tax break now, the contributions reduce your taxable income today, but you pay taxes when you withdraw in retirement. The Roth flips that. You pay taxes now when you're probably in a lower tax bracket and withdraw tax-free later. For most people who are earlier in their careers, the Roth IRA is the better long-term deal. Tax rates in retirement are genuinely unpredictable, and locking in tax-free withdrawals eliminates that uncertainty. For viewers outside the U.S., the Roth IRA is a U.S.-specific account. The concept, though, applies everywhere. Almost every developed country has built a tax-advantaged savings vehicle for this purpose. In the UK, it's a stocks and shares ISA. You can invest up to £20,000 per year and pay no tax on the gains or dividends. In Canada, it's the TFSA, tax-free savings account. Contributions grow and can be withdrawn completely tax-free. In Australia, the equivalent is superannuation, though it operates differently with mandatory employer contributions. If you're somewhere else, search tax-free investment account or tax-advantaged savings account plus your country name. These accounts exist because governments want people to save for retirement. It reduces the burden on public pension systems. Use the vehicle they've already built. Simple first step. If you're in the US, open a Roth IRA with Fidelity or Vanguard today. Both have clean interfaces, no minimum to open, and a solid range of low-cost ETF options. Set up an automatic monthly contribution, even $25. Buy a Dividend ETF inside the account. Done. If you're outside the US, find your country's equivalent this week and open it. The longer you wait on this one, the more tax-free compounding you're leaving on the table.
Here's what the full picture looks like when these three accounts are running. Your high-yield savings account is your floor. 3 to 6 months of expenses, earning real interest, accessible when you need it. It doesn't build your wealth directly. What it does is keep you from making panic decisions with your investment accounts when something expensive happens. And something expensive always happens eventually. Medical bills, job transitions, car repairs. The cushion means you don't have to sell investments at the worst possible time. Your brokerage account with Dividend ETFs is your income engine. It pays you on a schedule, reinvests automatically, and grows whether or not you're paying attention. It has no contribution limits and no restrictions on when you can access the money, which makes it flexible. The trade-off is that the dividends are taxable, so it's not as efficient as the Roth IRA for long-term compounding. But it also doesn't have caps, so once you've maxed out the Roth, this is where the rest goes. Your Roth IRA is your long-term compounder. It works quietly for decades, tax-free. It's the account you'll be most grateful for at 60 that you almost certainly won't feel much about at 28. That's by design. The time horizon is long on purpose. You don't need to manage these accounts actively. You're not picking stocks, you're not timing the market, you're setting up automatic contributions, buying diversified funds, and leaving them alone. The less you touch them, honestly, the better the outcome tends to be. The one thing these three accounts require is that you start before you feel ready. That feeling of readiness, more money coming in, a clearer plan, a better understanding of how everything works, it doesn't tend to arrive on its own. Most people who are waiting for it have been waiting for years. The people who built financial stability didn't feel ready when they started either. They just started with what they had. $25 a month into a Roth IRA opened today beats $200 a month into a Roth IRA opened in 5 years. That's not motivational talk. That's what the compound interest math actually shows. Before the outro, a few things that trip people up with these accounts. Waiting to have enough to start. There's no threshold. The minimum viable amount is whatever you can put in today. You can always increase contributions later. The account being open and funded matters more than the dollar amount in year one. Treating the high-yield savings account as an investment. It's a safety net. Don't pull from it to invest in the brokerage unless you've already rebuilt it to your target. Using your emergency fund to buy ETFs feels smart when the market is up. It feels catastrophic when the market drops 20% and you get hit with a car repair at the same time. Turning off dividend reinvestment to take the cash. If you don't need the income right now, reinvesting is almost always the better move. Taking dividends as cash slows your compounding significantly. The point of DRIP is that you don't have to think about it. Set it and leave it. Opening the accounts and then not contributing. An empty account earns nothing. The habit of funding it consistently, even small amounts, is the actual mechanism. Automate the contributions so you don't have to remember or make the decision each month. Selling when the market drops. The brokerage account will go down at some point. Everything does. If you've built your emergency fund first, you don't need to sell. You can wait. That patience, the ability to sit through a down market without touching the account, is one of the most valuable financial skills you can develop, and it's made a lot easier by having that savings cushion behind you. Here's what I want you to take from this. These three accounts aren't a shortcut. They're not going to make you rich by next year. They're not exciting to talk about at dinner parties. But the people I know who built real financial flexibility over time, who can say no to jobs they don't want, who don't panic when the car breaks down, who have actual options in their 40s and 50s, most of them built it with accounts like these. Slow, automatic, boring, consistent. The passive income starts small, a few $100s in dividends your first year, then more. Then, 10 or 15 years in, the math starts doing something that feels different from anything you'd expect when you put in that first $50. The thing that doesn't get said enough about this is that you're not really trying to get rich.
You're trying to get to a place where money isn't the thing that makes every decision harder, where you have some room, where a bad month doesn't mean a bad year. These accounts are how that happens for most people. The only version of this strategy that doesn't work is the one that you don't start. If this gave you a clearer picture of where to start, a like goes a long way. It helps the algorithm put this in front of people who need it. Subscribe if you want more content like this. New video every week. One question: which of the 3 accounts are you opening first? Drop it in the comments. I read all of them. Thanks for watching. Till next time.